want to see my broker, find out what he can do, 'cause I'm in the market for you.
Welcome to Stock Talk Happy Hour, where we have casual conversations about stocks, the market, and trading with other traders.
You're going up, up, up in my estimation. I want 1,000 shares of your caresses.
We're happy to have Steve Swetz as today's guest trader.
And kisses when dividends are due, 'cause I'm in the market for you.
Well, today's guest is Steven Swetz, and I want to thank you for being on our web show. It's great to have you. You know, you've been in our chat room now for a while, and I really appreciate all the great stuff that you share with the other traders, and especially people who are new to trading. I think they really benefit from your perspective on things.
Well, I do appreciate that. And to be honest with you, I'm really, really excited that you even started this chat room, because really, there really wasn't any place on the internet besides message boards where you could have a real-time conversation between, two traders who wanted to talk Can Slim or some other type of stock trading method. So that was great to open up that avenue to people all over the country and actually all over the world. So that's just awesome.
Yeah, I'm really happy with how it turned out. At first when I got it going, I didn't know if anyone would be interested, but it's been a tremendous success. I'm really pleased with it, and we still have plenty of room to grow too, so that's nice.
That is, every time I see something like this, some kind of new advancement in social networking, I go back and think about when I first got started in trading in the late 1990s. The internet was, it was just in its infancy. So you didn't have all the social networking, and you didn't have, this ability to be able to talk to somebody in California or New York or Europe on Can Slim or some other method. And so here I was in Mississippi, pretty much the only person trading Can Slim in my area, didn't have anybody to talk to. So really all I could do is read and reread and reread all of William O'Neill's books. He did anything. What? Hold on. I don't remember reading that the last time I picked up this book. And so it seemed like every time I was reading the book, I was picking up something new. And then I was making so many mistakes. And it would have been nice if I could have had somebody to kind of talk to, a kind of a mentor, to let them know, look, I don't think I'm getting this system right. Can you show me what I'm doing wrong? I didn't have that back in the late 1990s.
Oh yeah, it's always great to get feedback. Even just knowing that other traders are going through the same maybe frustrations when times are rough and success when times are good, that alone in itself is really valuable.
Oh yes, no doubt about it.
Well, you've started a perfect segue into the question I was going to ask you is just can you tell us a little bit about your trading history and how long you've been trading and what style you like to trade?
As you probably already guessed, I love Can Slim trading, but what's funny about it is I've always been interested in the market in my early 20s and when I was in high school, but then I didn't have any money, so I just kind of followed it, read the papers sometimes, went to the library, read the S&P reports, things like that. And so, I would do that kind of thing. Always interested in the stock market. Well, finally, when I graduated from college, I started going to the bookstore, finding stock market books. And actually, the first couple of books that I bought were actually Peter Lynch's book, One Up on Wall Street, and Warren Buffett's book, The Buffett Way. I thought, well, those two guys, I've heard of those guys. I know they're successful. So let me just kind of read what they have to say. And I'm just going to follow in their footsteps. And, I read the books. And to be honest with you, I thought, no, this style just doesn't fit my personality. And so I go back to the bookstore and really just actually dumb luck. I'm going through it and just kind of looking at the titles. And I come across How to Make Money in Stock. I think it was the second edition. And back then it was a crimson red book. Well, anyway, I open it up and I look at it, and it just kind of struck a chord with me. It's like, wow, I like this. I like this methodical approach, looking at numbers, analyzing them, looking at chart patterns. And I didn't know the first thing about charts at that time, but it was just something new, interesting, something I've never seen before, because I've always, even in college, they would teach you about value investing, and you don't want to fool with those stocks with the high PE ratios. So it was here I'm reading a book that is the antithesis of everything I learned in college. And that even intrigued me even more. And I think what really got me into Can Slim, I still remember the very first stock I bought using the system was a stock called Timberland Software. I still remember the ticker symbol, TMBS. I don't think it's around anymore, but I bought that stock. And at that time, I had a piddly, I think maybe $2,000. And I doubled it to $4,000. And to me, that was like everything. I thought, wow, this is amazing that I was able to turn $2,000 into $4,000. I thought this is just the greatest system on the face of this earth. Little did I know that I was getting just in the beginning of the internet craze, and of course Can Slim, buying these growth stocks. I mean, that was just the perfect method during the perfect time. And so you're buying these stocks like Yahoo and these other stocks you guys probably never heard of now, but Network Solutions, which was a great winner back then, SDLI. Stocks that don't even trade anymore, Qualcomm, that still trades nowadays. But these stocks are just taking off, and this Can Slim system was working out so great. And I thought, wow, man, I'm going to be a millionaire. I'm going to retire next year. All these harebrained ideas. And then what was so crazy for me was I even remember back in March of 2000, I was reading the paper every day. And I was just following along, and it was telling you you need to start getting out of the market. And what got me was I actually got out of the market pretty close to the top in March of 2000. But what messed me up was, I was still young. I had never really been through a real bear market. I'd go through the 1998 bear market, but that lasted maybe 2 months. Nothing really serious. So as this market was pulling back in 2000, I was thinking, okay, I'm going to buy the dip. Well, it kept dipping lower and lower, and I kept buying the dips every time. And I just kept taking one loss after another loss after another loss. I'm thinking, no, this can't be happening to me. And, money I was making on the internet, the craze, I was losing it all during 2000, especially 2001. It was just like everything that could possibly have gone wrong. If you would have picked the very opposite stocks that I was picking, you would have been a millionaire in 2001 and 2002. And I even remember getting this smart idea after the market was already down about 40 or 50%. I thought, you know what? I think I'm gonna start shorting this market now. Well, I think I shorted it right at the bottom. And so as soon as I shorted the market, it just started zooming back up. Nothing I could do right. And what was so bad was, I think it actually messed me up. By having some success early on, it taught me some bad habits because I would buy stocks, extended, it pulled back. I wouldn't worry about that 7% stop loss rule. Oh, it's coming back, and it would during the internet time. But then, finally, all these bad habits that I was creating for myself that I didn't realize at the time because, anybody could have made money in the late 1990s buying internet stocks. And I just happened to be in the right place at the right time. Well, in the early 2000s, all these bad habits that I had formed for myself, they were killing me. And I was just losing money at, just losing. And I said, look, I've got to just forget about all this stuff. I've got to start back at square one. I've got to reread those books. I've got to look at all the mistakes that I made, which, oh my gosh, I made so many mistakes, so many different kinds of mistakes. I even had one stock that gapped down 100 points against me.
Oh my gosh. I've always felt like people who have made the most mistakes actually end up being the best traders because they persevere, they keep going back, relearning the fundamentals or whatever it is they missed, slowly making small adjustments and improvements, and then, one day they're a good trader.
I mean, you hit it right on the nose because I remember when I was making so many mistakes. And I looked at myself and I said, is this something I really want to do? And I did. I just love, even though I wasn't doing well and I was trading so poorly, I love the stock market so much. And I wanted to learn it so badly. And I knew it was possible because I knew I had at least at one time I had success. Even though it was fleeting, I knew it was possible. And I would read, William O'Neill and these other guys, that Nicholas Darvis and Gerald Loeb and Richard Wyckoff and Jesse Livermore. And you would read about all these stories of all these great traders over the last 100 years. And I thought, well, I know you can do it. I'm just not doing it right now. And so I said, I'm just going to stick with it, keep going back to the, drawing board. And I was able, as the internet was starting to kind of, take off a little bit, and there was, more social networking. I was lucky enough to actually get in touch with some pretty successful traders who traded a similar system. We would exchange emails and things like that, and they really helped me kind of turn the corner, because the whole time while I was making money and then losing a bunch of money, I never had any rules. I never had a real set routine. I read the books, but I didn't really, take what I read in the books and actually write down a set of rules that I was going to use for myself. I never did have a set routine that, okay, this is what I'm going to do every night, every weekend, in a methodical approach to help me find the right stocks, be ready to buy them when they break out, or break out from some other setup. But I just didn't do all that kind of stuff. I was just kind of winging it. I just go, I'll just kind of open up the computer. I'll hit my mouse button a few times, and money's just going to fall out of the sky.
It also sounds like you didn't really understand the importance of market direction.
Oh, I didn't. You're exactly right. Through the 1990s and even 2000, we just really never had a bear market like we had in 2001 and 2002. And here I was, inexperienced, like you said, had no understanding of the importance of being on the right side of the market. It's funny, you read the book and you think you understand concepts, but I wasn't, because even though in the William O'Neill book, the M was probably the most important letter of the CAN-SLIM method, but here I was, read the book 3 or 4 times, and I still wasn't getting, it just wasn't sinking in. I don't know why. Maybe I'm just slow, but I think it just wasn't sinking in.
No, I think it's for people who are new to trading, I think that's kind of a hard concept to grasp, even though it sounds simple, but to really understand it and apply it, I think takes practice. But speaking of market directions, what are your thoughts about current market health? Anything particular you like to do to get a clear sense of market direction?
Well, I'll tell you, I really do something very, very, very basic. And, the one thing is I do look at distribution days, and I do look for, follow through days based on the definitions that the CAN-SLIM method, teaches us to look for. Yeah, one of the things what I like to do is look at the NASDAQ chart, and particularly the weekly chart. And really all I'm doing is I'm looking for turning points. And when I mean turning points, what I'm looking for is, I don't know how many people in the audience are familiar with Richard Wyckoff's version of a selling climax followed by an automatic rally followed by a secondary test, which could possibly stop the downtrend. Well, in this case, this wide range strong close up bar right here, it's got selling climax characteristics. This wide range strong close bar with this huge volume right here, which you can kind of see a little bit better.
Are you talking about the down day?
Yeah, well, the down day, they end up closing at the high. See, down here, 42.92 closes at the high.
Yeah, that looks like a good shakeout.
Yeah, exactly. Huge volume. So, here we go. We shake out all the weak holders. You got buyers coming in supporting this market, which we can tell by the extremely high volume. You've got the
and it's got a strong close.
Yeah, exactly. So, the institution, somebody saw value at this price. So they come in, they swoop in, they buy shares, causing this little rally right here, which in Wyckoff terms will be called an automatic rally. And then you've got this retest, this reaction down here. And this reaction occurs on less selling volume than what occurred on this first reaction down to this 42.92.15 support level. And so right here, what I'm doing is I'm looking for what are the leading stocks doing on this test. And so if I'm going, I'm going to the IBD 50, I'm looking at stocks with, very high composite ratings, very high relative strength ratings, which have formed bases and that have shown evidence of institutional accumulation within that base. And if I can see a lot of candidates that meet those criteria, then I get very excited about entering positions when the market is doing the major indexes, especially the NASDAQ, is forming this kind of secondary test. And so for me, that's my clue. That's my cue to start putting money to work on the long side.
Do you like to enter on that on a positive retest, or do you
Yeah.
wait for the official follow through date?
And I will bring out a chart and show some examples on those days. Let's pull out. I think that was the first stock I bought. But here's EEFT, and up here is not the NASDAQ, but the S&P. I mean, they're both pretty much, I use them both, but I guess for purposes of this, I've got the S&P index up here, and you can kind of see this selling climax action. There was a secondary test here, but the problem with that secondary test, I didn't see any leading stocks that were forming sound bases, that were triggering, coming out of tight ranges, doing the things that I like to see leading stocks do. But by the time this secondary test formed right here, you had this rally day in the S&P, where the S&P closed higher than it did the day before. To me, that rally day, that's my cue to start buying leadership stocks. And on that same day, EEFT, it formed a nice base, real tight area right here. And actually, on the day of this rally day, it had a pocket pivot bar. And people are familiar with Gil Morales and Dr. K's books. A pocket pivot is just basically a strong close up bar that either closes above a 10-day moving average or a 50-day moving average, 10-day moving average in this case, where the up volume is higher than any down volume during the previous 10 days. So as we can see from right here, there wasn't any down volume, looking at these red bars, that was higher than this up volume on this day right here. So near the close, I'm buying EEFT right then. And then the very next day, it goes up higher. I buy more shares this following day. So these are the ways how even though a follow-through day hasn't occurred as defined by CanSlim, a rally day has occurred, and we've got evidence from this action in the major indexes, both the S&P and also the NASDAQ, that you've got this sideways trading range that may be temporary, but at least for now, the downtrend has stopped. And whether a new uptrend begins to occur, that remains to be seen. I mean, now we can see that some kind of uptrend is in progress. But during this day, in real time, you don't know about all this. All you know is that you've got a rally day, and you've got stocks like an EEFT, you've got a stock like a UVE, which have formed bases, have these strong CanSlim characteristics with strong earnings growth, strong relative strength, strong sales growth, accelerating earnings growth. It's all those characteristics that we look for in a CanSlim stock. It was demonstrating those characteristics. And so here you go again, you've got this cup, you've got this real tight action with decreasing volume, and then you've got this explosion. There was the rally day in the S&P. I catch this stock as it's breaking out of this little cup area, that cup handle area right here, and breaking above the sloping trend line of the cup. And so that was my cue to start buying UVE. And so these are the things I'm doing as I'm getting, a signal that now's the time to buy stocks. And if these stocks didn't work, and I've gone through it lots of times when, I'll get in thinking that, okay, this is the time to start buying stocks. And, and 3 or 4 days later, they come crashing back down. And so I just, take my losses, move on, and wait for the next opportunity. But so far, one thing I found over these years that I think one has to be willing to get into stocks before you see a follow-through day. I'm more convinced of that now than ever, because usually by the time that I follow, so many people now follow the CanSlim method. They see the follow-through day, and they'll take it then. Well, sometimes by the time the follow-through day occurs, hey, you're already 5, 6, 7 days out of the uptrend. And there were a lot of leaders that broke out in those first 5 or 6, 7 days that you've missed because you're waiting for that follow through day to occur. But the true leaders, in my experience, they'll break out before the follow through day even occurs. And so those true leaders are the ones that you really want to get your money into, because by the time the follow through day occurs, they've already gone. They've left the station, and it's going to be a lot harder to be able to catch on to those because they've already gone. And so I'm just that's just kind of the way I approach the market these days.
So given the current market environment, and the strategies that you like to trade, you feel that you really need to get into the stock that has a good base and all the can slim qualities, but you need to do it without waiting for a lot of confirmation.
That's right. That's exactly right.
While you're getting this chart set up, I'm going to ask you a quick question. Are there any particular indicators or oscillators or other kind of charting tools that you like?
Moving averages.
I see that you have, it looks like the 10, 20, and 50 up there. Is that right?
10, 20, and 40. That's what's on the weekly. But you're right. On the daily, I use a 10, 21 exponential moving average and a 50 and a 200-day simple moving average.
So pretty much just price and volume and a couple of moving averages.
When I was doing so badly as a trader, and maybe that's the reason I'm so against indicators. I know a lot of people do very well with indicators. I know a lot of people who do. But I think I did so badly when I was struggling in the early 2000s, and I was using stochastics and Bollinger Bands and the shaken money flow. I don't even know if I'm pronouncing it right. The Williams percent. I mean, I could have told you. You could have asked me 10 years ago or 15 years ago what all these different technical indicators meant. I could rattle them off like there was no tomorrow. But of course, I couldn't trade any of them.
All indicators are just a derivative of price and volume action anyway, so why not go straight to the source?
That's right. And what I found out, if I'm focusing on, say, stochastics or MACD or something like that, what I'll do is I'll miss important observations from just the price and volume chart. And so, for me, I didn't want to miss those because, like you said, everything starts from price and volume. So that's what I wanted to hang my hat on.
Well, when you're looking for candidates, do you prefer to look for them on the weekly chart or the daily chart?
Actually, what I do, my weekend routine is I'll run about six or seven different screens through MarketSmith. And from those 6 or 7 screens, I'll get candidates, between, I'll say 200 to 300 candidates. And I'll just merge them all into a list. And then what I'll do is, I'll export that list into MarketSmith, and I'll have a monthly chart, monthly and a weekly chart right next to each other. And I'm just hitting the space bar, going through those charts until I see something that, catches my eye. And then once it catches my eye, I'll flag it, and then I'll come back and look at it more deeply. I'll analyze maybe the weekly base, how many accumulation weeks, distribution weeks, are there elements of demand, elements of support within that base? What's this relative strength line looking like? Can I identify a pivot point? And when I'm doing that exercise, I'm looking at weekly and daily charts. So I start out just monthly and weekly, just hitting space bar. And really, when I'm doing that, all I'm looking for is I'm looking for really strong prior uptrends, and I'm looking for bases. And that's really all I'm looking for. So I can hit that space bar pretty fast because I'm not really, analyzing the chart in depth at that moment. I'm just trying to see if there's something that catches my eye. And if there is, I'll flag it, come back to it later. And then maybe when I've got a list of maybe 40 or 50 stocks, then that's when I'll analyze each chart, more closely to try to whittle that universe of, say, 40 or 50 stocks maybe into a manageable watch list of maybe 5 stocks that I'm going to track every day, throughout the week. And then next weekend, I'll go through the whole routine over again and come up with another 5 stock watch list for the subsequent week.
Well, I think monthly charts are one of the most overlooked charts for most traders, and including can slim traders. You can really get a great overview of the potential the stock has by looking at a monthly chart.
Heather, you are giving me goosebumps when you said that. I'm telling you, I mean, I if I saw you right now, Heather, I would hug you for saying that right there. I agree with you, not just 100%, but if I could agree with you 1,000%, I would, because I'm going to show you some stuff, and I know you know about it already, but I think a lot of people will find it interesting. Some of the information that these monthly charts will give you, and it'll hit you like, oh my gosh, I cannot believe I didn't see that. But I say, well, the reason you don't see that is because you're looking at a daily chart or a weekly chart, and there's so much information to gain from a monthly chart. It will blow your mind. It really will.
Well, let's get going. Show us.
Yeah, this is what got me started in taking these rally days more seriously. 2011, and this was when the Euro debt crisis was going on, and it seemed like every day it was. To me, the action during this time period in the fall of 2011 is a lot like what we're seeing now, where back then the S&P and the NASDAQ, the futures, they would gap up or the market itself, I guess, would gap up, gap down based on some overnight news that was coming out of Europe, because it seemed like Wall Street was hanging on to everything that Draghi was saying, or, every time that some other news related to some kind of Euro currency crisis was hitting the news wire, the market was gapping up, gapping down to reflect that news. Well, lately it's been China. If China's GDP, once news came out that China's GDP was maybe not going to be as strong as a lot of people might have originally thought, then you would see these gap ups and gap downs in the market when all this news was, would hit the news wire. Well, during this time, I remember when here again, you got the selling climax action right here, huge volume, huge breakdown, but here again on this bar right here with the strong close on this huge massive volume, here again, you got institutions coming in thinking that, okay, 1100 in the S&P, I can find there's value here, and so they're coming in, they're picking up shares at what they perceive is a good value. And so here we go. We're building this trading range. We're getting these little secondary tests right here. There's a secondary test right here. And then you get this shakeout right here. And I remember there was a rally day, real strong rally day on, I think it was first week of October. And I just remember that day so well. And I thought to myself, this would be a good time to start buying stocks. But I didn't buy anything this day. And I was going to wait for that follow-through day. Well, during this time, the follow-through day occurred somewhere around here. It was about the third week from this rally day when the follow-through day finally happened. So here I am. I start buying stocks around this area. And then what ends up happening is right after this week occurs, the market starts falling. Yeah, here I am buying the stock. And look what happens to me. And I'm thinking, oh my gosh. And and then what I did was I would look back and say, well, the stocks that I had on my watch list that were breaking out during this time that I did not buy, I'm thinking, I was looking to see, well, where are they performing? How are they doing? How are they acting? And they were still doing well. They were hanging in there. And so I would have been able to sit through this kind of reaction if I was buying some of these leaders that I liked in this area. But no, that's not what I did. I was buying them up here, and I must have bought 3 or 4 straight stocks, and I got stopped out of every one of them. Now I'm frustrated. Now I'm mad. Of course, just when I get mad, the real follow-through day occurs somewhere around here, and I'm late again. I'm like, oh, it's killing me. And I says, I've got to come up with a way to be able to not wait for these follow-through days, because some of these top leaders, I want to be on them. I want to really get onto them. And so I would go, I do a bunch of post analysis, did a lot of research, looked at past follow-through days, looked at past rally days, looked at the leaders of those, during those time periods. And just, I would ask myself the question, okay, could I have bought these stocks based on my rules on a rally day? And more times than not, I could have.
That's a great question to ask.
Yeah. And so I was doing the research, and when I came to that realization that when I see this trading range type of activity and this Wyckoff stopping action, his term, see that kind of behavior in the major indexes, I've got to be willing to use these shakeouts or use these rally days to be able to, if I see leaders breaking out, I've got to be willing to buy them. And usually it's the greatest time, because during this time, there's no follow-through day. people are still doubting the market. And just when everybody is doubting the market, that's the time that you want to start buying stocks, because that's just the psychology that you want to take advantage of. And it's so hard when everybody's so bearish. I remember this time, the market's going to go back down to the 2009 lows. Apple's no good anymore. I was just hearing it one after another. I would see a Q-Core. I saw an Apple. I would see a Baidu. I would see these stocks that were setting up. I'm thinking, I need to get onto these stocks. The bases are beautiful. The breakouts are beautiful. I've got to get on board. But after that experience right there, I said, I've got to come up with a way to be able to handle situations like that. And that's what's helped me handle the current situation.
So, Steve, you want to show us some monthly and weekly charts and some of the things that you look for on there?
I'll be glad to. And this idea came from, and I've mentioned this book actually on your chat room, Heather, The Perfect Speculator. And this is a book, I think it was written back in maybe 2006, 2005, somewhere around there. And it's funny, some of the best morsels of wisdom will come from little cheap $5, $10 books. And it really is amazing. And same thing with How to Make Money in Stocks. I used to give that book away for free every time I renewed my IB subscription. And I thought it was the greatest book in the world. But anyway, what I do, and one of the things I look for when I'm going through my weekend routine is I'm looking for monstrous volume coming out of not just a multi-week base, but a multi-month base. And that's what makes these monthly charts so beneficial. And I like to see stocks, if possible, I love to see this monstrous volume, which you can kind of see on the weekly chart here, and this breakout to a new all-time high here. And that's another reason I like these monthly charts so much, because you can get so many years of data. And so you can get an idea of whether is this a breakout going to a year high, or is this a 5-year high, or an all-time high? That kind of perspective is what I like to gain from looking at these monthly charts. And so when I'm tabbing through and I see this huge volume bar right here, and I see this just tremendous breakout to an all-time high. Here's a young company, a biotech, which at that time, 3 of O'Neill's growth mutual funds that William O'Neill likes to track, 3 of them actually owned this stock during this time period. So even though the earnings per share, didn't look so great, but sometimes when you see such tremendous volume like that, there's got to be some major institutions that see something down the road in this stock, and they want to get on board. And so maybe, even though I don't understand maybe quite what they're seeing, what I do understand is if they're going to stick their neck out this much, then I'm willing to at least stick my neck out a little bit.
Mm-hmm.
And so when I see this kind of buying, see this kind of action right here, and then I see this base form, to me, this right here is just it's the trigger that says, okay, Steve, pay attention to this stock. Something important is happening to this stock. I need to track it. I need to stalk it.
So you like to zero in on those horizontal consolidations.
Exactly. I want to see huge breakouts out of these horizontal consolidations. And now what I want to see next is, a base, a double bottom, a cup with handle, a flat base, all those kind of basic bases that William O'Neill teaches us to look for. And so that's what I'm doing next. And as this base is forming, in this case, it was a double bottom, then what I want to do next is I want to find real tight action on the right-hand side of that base, because by doing it that way, I can place my stop pretty close to where my entry price is going to be. I'm getting into a position where I can reduce my risk. Hey, if it breaks out and comes back down, so be it. I get stopped out. But I get stopped out for maybe a 5, 6, maybe a 4% loss. I can handle that. But I just don't want to get in a position where I've got to put my stop maybe 10, 15% away from my entry price, because then I'm thinking, well, for me to come up with a favorable reward to risk ratio, I've got to hope this stock goes up 30 to 45%. Well, maybe it will. That's a harder measure of performance to achieve. It's a lot easier to look for a stock that can go up 20, 25%. Stocks can do that. That's not that hard of a task to do. But, hoping that a stock's going to go up 50%. Hey, if it does go up 50%, that's great. But I don't want to go in thinking that, if this stock doesn't go up 50%, my reward to risk ratio is not going to be that good. I just don't want to get in that kind of situation. I just love that tight action for Bluebird. The action got really tight. The volume started shrinking. And that was my cue that, okay, any day now, any day that it's, once it breaks out, I've got to go with it. And it did. It broke out and I went with it.
So do you like to shoot for a risk-reward ratio of 1 to 3? Risk 1, reward 3.
Exactly. Yes. It's funny, really, everything that I'm saying, nothing is original. It's coming from a book I've read or, something like that. The only thing that I can say maybe that's original about it is, I'm taking something from the Perfect Speculator book. I'm taking something from the William O'Neill book. I'm using a concept that Wyckoff came up with 100 years ago. And I'm kind of mushing it all into a method that works for my personality. And I've devised rules that help me implement my method based on these ideas that have been around for 100 years, 50 years.
You don't need to reinvent the wheel. All you need is rules.
And that's what I'm doing. And when I'm going through these charts, Tesla was a great example. Here was a stock that spent months and months and months and months doing this real tight consolidation. And then right here, this month, volume just to historic highs. It's never had a monthly volume amount that big. During this time, huge weekly volume breaks out of this little consolidation here. Unfortunately, I did not see it during this time, but I saw this and I thought, well, maybe if I can get a pullback, this pivot point around 40, I can get on board. And, it was one of these ones that worked out. But these kind of opportunities, it's not like they come across like this all the time. Now I'm showing you some of the best ones, but you only got to get a few of these best ones to make up for all the screw ups I'm going to no doubt do. If you can, identify these huge breakouts from these, not just multi-week, but multi-month. You see it right here. You see it, these weekly bars took up several months of action before it finally broke out. And if I'd have been more attentive, maybe I would have just bought it on this breakout, but I didn't. But I did buy it on this pullback. But these are the kind of things that I look for, time and time again. 5 Prime Therapeutics. Until about a month ago, I didn't pay any attention to this stock. But here's a stock, after months of activity, here's a young company that just zooms out of this multi-month consolidation with just the largest volume that it's had since its history. Here's a young company. They just signed this pact with Bristol Myers Squibb. You've got huge buying coming into this stock. Now, what I'm going to do right now is, it's not forming yet, but I'm just looking for a base. I'm looking for a flat base. I'm looking for a double bottom. I'm looking for a cup and handle, but I'm looking for some kind of base pattern to form over the next, 3, 4, 5 weeks. And then what I want to see is as soon as I can identify some tight action on the right-hand side of that base, that's going to be my cue to say, okay, as soon as it breaks out of that tight action, that's what's going to trigger my entry.
So some of the things that you like to look for an entry trigger are a base, a trend line being broken, and some tight action on the right side of the base.
Yes. In fact, these cup patterns, I'll actually miss those. I'm not good at I never have been good at it. Handle, it just does a cup and breaks out. I miss those every time. I do. I'm just not good at entering a stock that way. I've got to see tight action before I enter a stock.
What do you like to see the volume doing while it's forming that tight action? Drying up?
Drying up. Oh, yeah. The more it dries up, the better. Narrow range bars, drying up a volume. I see that kind of action. I can't wait to turn on my computer screen. I just can't wait. And this is the one I was wanting to show you, Radius Health. You want to see a model behavior for tight action, on the right-hand side of the base. You see this huge run up. During this time, you're seeing this huge, volume bars, huge run up. While this was happening this time around here. And so, we see this huge run up, this breakout. And when I see this tight action, this is 4 weeks tight. You see these closes, all clustered together. Just super tight action. You see the volume decreasing from where it was just 2 or 3 weeks ago. This is one of those stocks every day I would wake up and say, oh, is this going to be the day that Radius Health is going to break out? I've been looking at this stock for, I remember, 2 straight weeks. Just waiting, just any day now. I'm just waiting. And finally, when it broke out, I was like, Oh yes. I mean, I was dancing around in my room. I'm thinking, man, finally this thing it is taking me, it's taking this stock 2 weeks to do this kind of action. And I was talking to some friends of mine. I said, and they would say, Steve, come on, this stock's never going to break out. I said, it's taking 3 weeks for this thing to break out. I'm just giving some time. If it ever breaks out, we're going to make some good money on this thing. And finally it did. So, I mean, that's what I look for.
That's great. One thing we kind of just breezed over that maybe we should talk about for just a second is what kind of stocks comprise your overall stock universe. I mean, I know what you like on the chart, but what kind of criteria do you have for your stocks?
I'll say when I'm putting together my universe for the weekend, my screens are actually really, really simple. It's almost like, Steve, is that the best screen that you can come up with? It's so simple. I said, I know it's simple, but really my screens basically come into two categories. I'm either looking for stocks with a relative strength rating of at least 95 with liquidity. Sometimes I'll go as low as $5 million of average dollar volume, but I prefer looking for stocks with $20 million of average dollar volume. But I'm looking for either stocks with a relative strength of at least 95. If it's 95 relative strength, I'll accept a poor EPS rating or composite rating because my thinking goes back to Blue and Radius Health. There's something special happening with these stocks for institutions to just pile on top of themselves, wanting to get into the stock, something that's coming down the pipeline. The reason they're buying this stock might not be known for another 6, 7, 9 months down the road, but they're putting money to work, and I need to pay attention because this stock is showing such exceptional relative strength.
Now, do you put the emphasis on the relative strength rating or 3-month or 6-month relative strength?
Just the relative strength rating. And I also put a lot of emphasis on the relative strength line. I want to see that line either diverging in a bullish manner versus price, maybe going up to new highs before price goes up to new highs, or it's in a strong uptrending, angle of ascent, those kind of things. And if a stock doesn't have a 95 RS rating, then what I'll do is I'll look for stocks with a composite rating of at least 90. And if it's a smaller cap stock, I want it to be at least 95 composite rating. And those are the main things that I look for. But then, once I've got my universe of, 200 or 300 stocks, and, it's going to be either a composite rating of at least 90, it's going to be a relative strength rating of at least 95. Once I've got that universe together, and I put them into a list, what I'll do is I'll sort them first by industry group rank, then I'll sort them by composite rating, and then I'll sort them by relative strength rating. So those top stocks in each industry group will float to the top. Those are the ones I really want to pay the most attention to. The very top stocks in each industry group are the ones I really want to, focus my attention on and where I want to put my money if they can break out. If I want to show a losing stock, I don't want to show just winners. That's no good. That's just not reality, and that's definitely not mine for sure.
Well, that was actually something I was going to ask you is, how do you differentiate between a good setup and a great setup? And by looking at some losers, I think we'll probably get the answer to that.
Yeah, because I think my problem is I always think all my stocks are great setups, and then until they turn into be losers, and I'm thinking, what in the world did you see there, Steve?
I'm constantly telling myself that all stocks are bad stocks. There's no such thing as a good stock.
That's right. Unless it goes up, it's no good.
And even then, it's still bad because eventually it's going to come back down. So you can't trust them.
That's true. That is very true. But here's one. I mean, to me, I thought it was just beautiful action. I mean, here's O'Reilly Automotive. I knew that, this stock's been up for a long time. And the left-hand side of the space was a little bit wide and loose. And, I saw all this stuff. I fall in love when I see this tight action and I saw this volume decreasing down here. I thought, yes, this is perfect. I can't wait until it breaks above this level right here, and I'm going to get in. Unfortunately for me, I do get in. And I knew I was already in trouble because when it broke out, the volume was so poor. I thought, uh-oh. So that's okay. I'm going to give it a chance. But the chance did not last very long because the very next day it comes smoking down. And I've got a rule that says I can, instead of waiting for the 7% automatic stop out, which I put, as soon as I enter a stock, I immediately put in the 7% stop loss. But I've got 2 or 3, actually 3 early exit rules, which will allow me to get out of a stock before it reaches the 7% goal or the 7% loss. And one of those is a breakdown below the 21-day exponential moving average, or a stock that just comes down on stronger volume than it went up. And so it did both of those. I'm gonna give it one more day, but when it came back down below 250, I got out. And so I get in here, I get out down here. And unfortunately for me, I actually have a rule. I learned this from Mark Minervini, where it can kind of reset. You can kind of see it kind of rally and create this little pivot right here, back pretty close to where the original breakout point was. And I've got a rule where I can, if I see this kind of reset, I can buy it right here. But you think I did something that smart? No way. I did not even buy this stock. So when I saw it break out like this, I was too busy crying because I get stopped out down here. I never did re-enter right here, and I totally missed out on the great day that it had today.
Well, talk a little bit more about the stock resetting.
Okay, all right. Well, my favorite one is this reset. And all I'm doing is when I get into a stock and I end up taking a loss like that, what I'll do is I'll wait for a minor pivot point to form, which is what happened right here. You get a rally and you get this little pivot point right here.
Why are you calling that a pivot point? It's just because it's a small consolidation, or because it gapped up, or what?
It's a pivot point here, but only because it's got a lower high on both sides of this bar. So I mean, it made it rallied, it ran into some kind of resistance, and then this bar right here made a lower high versus this bar. So this is a pivot, but because it's like a swing high. It's just a pivot. It's just a resistance point between this bar and this bar. And so the way I look at it is, okay, here's a resistance point. That's me. I love to buy stocks that break above resistance points, whether they're pivot points of a whole base or some kind of little minor type of pivot point like this. If I see that kind of action, I'm willing to buy that stock as it breaks above this pivot point. I can give you another example. I'll even do this inside of a handle. Instead of waiting for it to come out of a handle completely, what I'll do is I'll wait. Yeah, here we go. Yeah, you can see how my marking's right here. But here again, you got this little pivot point. Here's the cup. Here's the handle. But inside this handle, you've got this little bar, which had a lower high right here and a lower high right here. And so this created a little minor pivot point. And so I'm willing to go ahead and not maybe put in a whole B1 position, but maybe half of a B1 position. They kind of, just start to put money to work a little bit before everybody else does. And so I'm willing, as soon as this little pivot point gets taken out, I'm buying this stock just under $50, like $49.75. And then by the time, it breaks up above here, I can buy more. But see, by the time I buy right here, my average cost is somewhere around here. So I've got more of a profit cushion in case this thing just doesn't work out very well. Well, if it comes back down, well, because I bought some of my stock down here, I've got a little profit cushion to play with. Maybe I get stopped out, and maybe if I would have bought the whole position up here, I might have taken a 3 or 4% loss on the whole position. But since I was able to buy some of it right here and some of it right here, if the trade didn't work, maybe I take a 1% loss, or maybe I break even. Or over a year, all these little where you save 1% here, 2% here, it really does add up over the year, because you think, wow, if I would have taken, if I've taken the 5% loss instead of the 3% loss, it's amazing. If you can just keep those losses so small, 3%, 4%, and even every once in a while, you'll get some of those gains that are 20, 25, and you get lucky every once in a while. You'll get one that's 50%, maybe 100%. They come across every once in a while, and it makes all the difference in the world, because you've kept your losses so small throughout the year. When you do catch those good ones, they really mean something.
When you're in a stock, where would you add to your position?
My rule on add-ons is once I'm able to move my stop on my original position to break even, then that gives me the go-ahead to add on. Until I'm able to move my stock to break even on my original position, I don't do add-ons.
When do you like to move your stop to a break even?
I've got two rules. I've got one rule that says, and this is what I've done with Fleetmatics, on the first reaction, and it breaks out to a new high, then what I'll do is that gives me the option, well, I do it anyway, is to move my stop right here to pretty much break even. So that's what I've done with Fleetmatics. I've got the position I bought right here and the position I bought right here. On the whole position right now, I've got a stop placed right below this bar right here. So now I'm free to go ahead and add on to this position. The other way I can move my stop to break even is if I'm up 12 to 13% on a position, that right there gives me the go ahead to and move my stop to break even. Because maybe this stock just keeps on going, goes up 13%. If it would have done that, that would have been my cue to say, okay, now it's okay for me to bring my stop to a break even. So those are the two ways that I can bring my stop to break even. Either a reaction breaks out to new high, then I move my stop to below the low of that reaction, or if it goes up 13%, I just arbitrarily move my stop to break even.
And then once this trade really starts to progress in your favor, do you just like to manage it based on moving averages and sell rules? Like the 22 sell rules that IBD talks about a lot?
I've got fewer. I got it down to about 12. And I'm still trying to get it down even lower than that.
So would you say moving averages are what you rely on most heavily?
Yeah, I use moving averages and I use just swing lows. For instance, here we've got a swing low. So, say I bought it somewhere down here. And the way I'd get out of this stock is I would need to see just a tremendous break below this swing low. Not just a dip below it, but it's just got to be a decisive break, close below it, or a decisive close below the 10-week or 50-day moving average, or I'm looking for climax action. So those are basically the ways that I can get out of a stock.
Do you prefer to scale out?
Yes, I do, especially if I see a stock that looks like it's going into climax action. I just do not. I hate to sell it all. In fact, David Ryan, I got this from him. He likes to do 1/3, 1/3, 1/3. And what I like to do is I'll do 1/2, and then what I'll try to do is do 1/4, 1/4. That's kind of how I scale out of. If I see a stock that I've got that's just making a run, and that's kind of how I do it.
Do you like to adjust your stop after you've taken some partial profits?
One thing I do like to do with partial profits, I've got my offensive sell rules and I've got my defensive sell rules. And the later we are in a market cycle, the more offensive I become. But the earlier we are in a market cycle, or if I've got stocks that are coming out of first stage basis, then I want to give my defensive signals. I rest on those. What I try to do is if I've got a stock that goes up, say 20, 25%, if it doesn't do that in the first, say 2 to 3 weeks, maybe 4 weeks sometimes, I'll go ahead and just immediately sell half and take my 20, 25% gain. And then what I would do with the other half is kind of like we already talked about. I'll use something like a 10-week moving average, a slice through that, a slice through the previous swing low, or I'll look for climax action. And if I see climax action, what I might do with that half is split that up in halves and maybe sell a little bit on half when I first see the climax action occurring, and then you keep the other half and try to pick a top. It doesn't matter about me trying to pick a top when I'm playing with casinos money, so I don't mind kind of doing that, but that's kind of how I handle those kind of situations.
Well, in general, how much money would you feel comfortable on average giving back before you take that final exit?
I don't even mind losing, say, 15, 20%. I think once I'm down 15, 20%, I'd be out. I don't even think that happens to me very often, because usually the swing lows will take me out before that 15, 20%, or usually the 10-week or the 50-day moving average is usually close enough to get me out. Or if it's that far away from those averages, then it's probably going into a climax top anyway. So I'm already starting to kind of, divvy out, partially sell my positions. By the time it's going into a climax run and it's pulling back, I might only have maybe 20% to a quarter of my original position left.
Okay, Steve, so let's talk a little bit about post-analysis.
Well, a lot of times what I do is probably what a lot of other people do. My way's not much different. When I buy a stock, I'll print out the daily and weekly chart and the monthly chart, and I'll kind of write reasons, or I'll circle. I have a red pen and a blue pen, and I've got it on. It's a Market Smith chart, and I'll circle the flaws that I see with the red pen and all the good things that I see that are good with the blue pen. And so I keep that in a folder. And then when I eventually sell that position, I will print out the daily, weekly chart again. I don't usually do the monthly when I sell, but just usually just the daily and the weekly chart. And then I'll just kind of write down reasons, why I sold it. What sell rule triggered that sale. Post analysis is so valuable, is that it'll open your eyes to different ways of approaching the market. You were asking me earlier about, well, how much of a pullback would I take before I sold a stock? And I can't believe it, but I remembered Alibaba, and it was about 20% that it came back before I sold it. But doing the post analysis of this Alibaba chart is actually would help me to come up with a different way of entering IPO cup pullbacks. And so what I did with Alibaba was, when I originally bought it, I bought it up here. To me, here was the cup. You had this little tight action right here, and I buy it right here, thinking that, oh man, this is great. And I've got, that rule where I like to be up 20% before I sell a stock. Well, I remember getting up to 120. I said, no, I'm up 19%. It's not 20%. I'm going to hold on to that baby. It's going to go up 20%. Well, it goes down. I said, well, that's okay. It's just a normal pullback. I'm going to be okay. It pulled back to this 21-day moving average. I thought, man, this is great. The rule I was talking about earlier where, once I'm up enough, I can move my stop to break even, gives me the ability to do an add-on. So that's just what I do. I said, all right, man, this is great. I use the 21-day exponential moving average as my, a rally off of that as my way to add on. So I add on like 20% of my position. So I'm in somewhere around here on my add-on. So I'm thinking, oh yes, rallying. Oh yeah, this is great. It's going to be up above 120. It's going to be a great trade. Everything's going to work out great. Well, I started seeing that I was getting worried because as it was rallying, the volume was decreasing. And I thought, uh-oh, that's not good. It's wedging up. I don't want wedging up. I want volume to be expanding as it's rallying. Well, that's not what's happening to me. It's the very opposite's happening to me. So now it comes back down. And now I'm down here. Now I'm I got stopped out of this position when it got down here. Now I'm thinking, oh, I had a 19% gain. Now I've taken a loss on this add-on position. All the profits that I've made right here, they've almost all gone away. But it's almost like it was toying with me. Like every time it would pull back, it would give me a little hope that maybe this is going to be the real rally. But eventually it comes all the way back down. And I think that little low right there, I believe I'm the person who made that low tick right there.
Oh gosh, that hurts.
I know. That hurt. Okay, I've got to come up with a rule. My post analysis, I've got my chart, and it's got red marks. I've got cuss words. I'm just like, Steve, what are you doing? Waiting for that last 1%? You turned a 20% gainer into a loser on this position and a break-even trade on this position. And then you're selling at the very low of the day. I says, how much worse can you trade in this stock? And so I've got a rule, and this rule would have never happened if it wasn't for Alibaba. This has happened to me before. I've got to come up with a rule to overcome these situations. So I've got a rule now where if I'm within 3% of my, say, 20% target, if I see like a wide range poor close bar, or I see a bar that trades below the lows of the prior 2 days, that gives me permission to at least sell half the position. And so that's the rule that I've come up with to handle these kind of Alibaba situations. But like again, I would have never come up with that rule if I wouldn't have done the post analysis on this Alibaba trade that I did so miserably on.
Oh, that's a great rule to take out of that. When you do your post analysis, what would you say are maybe one or two mistakes that are responsible for your biggest losses, or maybe a trade management error?
Well, I'll tell you, one stock, it was back in 1998, and I still remember that ticker symbol, ADRX, Andrix. And that stock right there really taught me the value of no matter how good the fundamentals are, no matter how good the current earnings growth is, the future earnings growth, no matter how beautiful the return on equity is, no matter what, when that chart tells you that the trend has ended and it's coming down, you have got to get out. You cannot make any kind of excuses. And so I remember with ADRX, I still remember even now, it's 1998, and I remember now that its return on equity was 42%. It had earnings growth of over 50% for like 3 or 4 quarters in a row. I mean, it was just everything that you wanted, had every can slim quality that you wanted. And what I did was, so I bought the stock out of a beautiful cup and handle, but it doesn't work. It comes back down. So I said, nah, this stock is perfect. So I'm going to buy some more at a cheaper price. I did that 4 times. I promise it. I don't know if it really did, but it felt like it did. I bet that stock went down 9 or 10 days in a row. And I was buying that stock, averaging down. I must have averaged down that stock 4 times. And every time, it was like, oh, I can't believe this stock is still falling. And that incident right there taught me the value of never, ever, 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 ever averaging down on a stock. I don't care what. Still bothers me. It's making me mad right now just talking about that 1998 Andrews trade. But I will never forget that trade. I never will, because also one thing that post analysis really helped me to do was it helped me to come up with some sell rules, because the buy rules to me weren't that tough. I mean, you got the base, you got the breakout. It says, yeah, there's things I can learn as far as distinguishing the high quality bases from the low quality bases. But, besides getting out when you're up 20, 25%, but what was happening to me a lot was, a stock would go up 20, 25%, and I would get greedy. I thought, oh, no, it's got to go up more than that. And usually what would happen more times than not, the 20, 25% gainers would just go, I'd get stopped out at break even or even a loss on those positions. And I did so many, on my post analysis, I saw so many of my trades that I'd let 20, 25% gains turn into 0% gains or 5% losses or something like that. I says, look, I've got to come up with ways to not only protect my capital when I'm up, but also have some kind of offensive selling rules to get me out of these positions. If anything, start taking half profits when you're up to 15, 20, 25%. That little rule I've got where, once I'm within 30% of my target, particular, if one of these 2 particular bar behaviors happen, then that's my cue to at least get out of half my position. If I can just take partial profits on these positions that, okay, maybe they don't go up. For me, I was thinking every stock I bought was going to go up 40, 50%, and that was just not reality. And so doing this, my post analysis, I realized that no, you're dreaming, Steve, if you think every stock you're going to buy has a chance to go up 40, 50%. That's just not what's going to happen. So I had to come up with better sell rules that worked for me to just be able to take, smaller bites. And I just go for home runs every time.
Well, what would you say are some of your biggest winners as you go back and do your post analysis? Did you notice any commonalities?
Yep. My biggest winners always seem to be the ones that broke out either before or right on the follow through day. I remember CMG 2010. And I remember that year so badly because I was getting chewed up pretty good after the flash crash in May of 2010.
I remember that.
Yeah, and we had real choppy action over for about 2 months through that summer. And I was just getting chewed up. I think I had maybe one winning trade that maybe went up 10%. And I took a bunch of 2% losses, 1% losses. I mean, it was just like, it was killing me. I says, no, I'm going to stick with the method because I know it worked. And so I did. And finally, around the August of 2010, CMG, it had the most beautiful looking cup with handle that I saw. I mean, it was just beautiful.
I was in that too.
Did you see break it out at 155? Oh man, I was just like, that was another one.
I made 100% on that trade.
Wasn't that a great trade? I'm not telling you, wasn't that a great trade?
I couldn't understand why all stocks weren't like that.
Because I remember this day right here when it just gapped up on the earnings release. I was thinking that, I was already up at maybe 60. I was up at maybe 60% at this time. And I just says, I'd gotten beaten up during this whole summer. And when it went up 60%, I said, man, maybe this is the buying climax. And I'm just going to sell half of it. And of course, it kept on going up and up and up and up. And I think I got out of some of the rest of it around 220, 230, somewhere around there. But yeah, I mean, that stock right there, when it had that perfect cup and handle, and as it gotten tighter and tighter, I know you've talked about this, and I love, because I'm a big believer in this, is that volatility contraction pattern that Mark Minervini teaches. Like I said, I love that tight action on the right-hand side of the chart. And nothing makes me happier than seeing like a cup and handle and a smaller cup and handle on the right-hand side of that base. And to me, that's what CMG was doing. It would have a cup here It had a little, like a smaller cup with a little smaller handle, and then just the handle just kept getting smaller and smaller. And it was like Radius Health. It was just like, I couldn't wait for this thing to break out. And when it broke out, it was the same day that the follow through day occurred. And I was just jumping all over the stock. That one and Priceline. The Priceline was amazing because I remember that stock, it gapped up way up here before the follow through day. And what was amazing to me about that stock was it kept going up while the market was correcting. And I thought, okay, if this thing ever pulls back, I'm going to get into this thing. And it got real tight in here, and the volume really dried up, and it was coming back down to this gap pivot point. As soon as it broke out above this little congestion area right here, I just started buying, and I added on some more right here.
You want to hear something hilarious about Priceline?
What's that?
I was going to get in it, and it was around 175, and I missed my entry, and I wanted to run up a couple of bucks, and I was like, oh, it's too expensive now. I missed my entry.
Hey, that has happened to me so much.
And now it's over $1,000. Oh my gosh.
Well, it's like CMG. I mean, it went to over $600, $700. But I was out of my stock back when it was maybe. I think I bought some more maybe around $300. But I never had it. When it was up at $600, $700, I was out of that stock way before it got up. Got up that high. But I was happy to take my my 80% gain or 70% gain, and then maybe 100% on the other part. But I mean, I was so happy with that. And if I would just kept it, I'd have been up maybe 300, 400%. Who knows?
That would have been fantastic.
Yeah, I know. I was out of it way before then. So.
Well, you know what? That kind of brings up the whole idea of psychology in trading. Yeah. So what do you do while you're trading that helps you keep your emotions, fear, pride, whatever, keep all that in check?
What I do is I've actually got my trade station set up where I cannot look at where my positions are. I can't look at, in fact, that's why I love your chat room so much. I use that as a way to not look at the market. I'd rather talk to you guys and talk about stocks without me like looking at, well, what's my position doing right now? Or, because once I start looking at the number value, then I want to start letting my human emotions creep in and make me second guess my rules, and it'll make me lose my discipline. I minimize the trade station on my computer screen, and usually what I'll do is I'll keep MarketSmith open. I just research companies. I go out and play tennis. I just do things so I don't think about all the intraday action during the day, because I know if I start thinking about that stuff, my emotions will get the best of me, and I'm gonna do something stupid. I try to do just do other things. Also keep my life a little bit more balanced, so it's just not stocks all the time. And by doing it that way, it does help me. It keeps me more focused on the rules and not so worried about every little intraday wiggle that's going on in my portfolio.
Well, I think that's something a lot of traders overlook, is that trading can be really stressful, and it just requires so much intense mental energy.
Yes.
That it's really important to stay healthy and find constructive ways to decompress, I think.
Yes, I couldn't agree with you more. I mean, you really do. I've got a stationary exercise bike at my house where, like I said, I go back out and play tennis. In my case, I'm preparing for the next day the night before. So I'm already spending an hour to two, usually 2 hours each night, putting together my plan for the next day. So when the market does open up, I don't feel that pressure like, oh my gosh, what do I do, like a deer in the headlights, like, oh, what do I do now? So my plan pretty much makes my decisions for me, instead of me getting in that position where I'm asking myself, well, what do I do now? I don't want to ask myself that question. I want that question already answered when I do my nightly preparation, the night before.
Yeah, you have to have a trading plan. You need to make decisions before you're put in a situation where you have to choose, and you're clueless. You're either going to be a deer in the headlights, or you're going to push ahead and do something foolish. That's the category I usually fall into.
I'm in that category all the time.
I'm charged with guns blazing.
I know exactly what you mean, Heather. Exactly.
Well, there's probably a lot of new traders or people who haven't been trading that long that are listening. And so what would you consider to be maybe 2 or 3 of the best or most important books that you've read that relate to trading that you would recommend?
I'll tell you what, from a psychological standpoint, I love Mark Douglas's book, Trading in the Zone, because I like the exercise that he wants the readers to perform after reading his book. I can't tell you how many times I've done that exercise, which has helped me come up with the rules I've got now, besides my post analysis. And so I love that book. Perfect Speculator is such a simple book, but the principles in that book to me are timeless. Complements William O'Neill's book, How to Make Money in Stocks, so well. And it complements Nicholas Darvis's book, How I Made $2 million in the stock market. If I could take just those books, the Darvis book, the William O'Neill book, the Perfect Speculator book, and then the Douglas book on trading in the zone, those 4 books, and if I had to add a 5th book, maybe I would add Reminiscences of a Stock Operator by Jesse Livermore, or maybe Mark Minervini's book, because I like his concept of volatility contraction patterns.
I really like Mark Minervini's book, and I also like Jesse Stein.
Oh, yeah, I've read that book. I like that one. Yeah.
That's a great book.
Yeah, it sure is. It really is.
For me, it would be O'Neill, Jesse, Mark Minervini, and then from a psychological perspective, probably Why You Win or Lose by Fred Kelly. That's another really old book that was written, I think, in the 20s or the 30s. And then I like The Disciplined Trader by Mark Douglas more than Trading in the Zone.
They're both good. I mean, I like them both. See, I know why you like that one, because that was a more technical book. See, you're smart enough to understand that book. I'm a Southern boy. I gotta get a simple book.
Oh gosh. What are some important lessons that you've learned as a trader that have helped you personally improve your trading?
I think the main thing that's helped me is it's okay to be wrong. I mean, if you can get over that roadblock of it being okay to be wrong, because everybody wants to be right. It's natural to always want to be right. But if you can get over that hurdle of just saying, hey, I'm wrong, so what? It's okay. I'll be wrong tomorrow. I'll make a losing trade the next day. I mean, that's just how it goes. And once you truly accept that it's okay to be wrong, then I also think what happens is your fear goes away, because then what are you scared of? I mean, if you're not scared of being wrong, you already know what you're willing to lose. I mean, you've got your stop loss in place on every trade. So, if you're not willing to lose, say the 400,000, whatever you're comfortable losing, if you're okay with that and you're okay with being wrong, then all of a sudden there's no fear. And then once there's no fear, then there's no hesitation. And it's like a domino effect, because once you lose the fear emotion, then it gives you the ability to act quicker. Then all of a sudden, when you start acting quicker and you're getting in at better prices, you start getting better results. And when you get better results, you get more confidence. And then when you get more confidence, you're more able to repeat the process and trade successfully over and over and over again.
It's true. It snowballs into a positive effect. And a lot of traders don't really realize that it's okay to lose money as long as that money that you're losing has been anticipated in advance and controlled.
Yes, no doubt about it. And I like Salem Abraham. He was I don't know if he was a turtle trader or maybe he was taught by a turtle trader, but he runs a hedge fund now. He trades with the canceling method in a way. He didn't mind being wrong, and the way he looks at each trade is he comes to the realization, okay, this is how much money it's going to take me just to see if this trade's going to work out or not. Not even looking at it as being right or wrong, just saying, okay, is this trade going to work out or not work out? And that way you kind of take the ego, the psychological impact away a little bit, because you're using different terms to define whether a trade's going to work out or not, instead of, oh, I'm wrong, oh, I'm right, that kind of thing.
I don't think that anything that we do is really about being right or wrong. It's, was this action or decision profitable or was it unprofitable? Because
exactly.
We're here to make money. And did we make money or did we not? And let's figure out why.
I mean, this is just great stuff.
What 2 or 3 pieces of advice would you maybe give to some newer traders or maybe even people who've been trading for a while that want to improve their results?
Don't give up, especially if you're new. It really did. It took me 6 years to go from a losing trader to a trader that started, making money consistently. 6 years. I mean, that's a long time that's a lot of days of saying, is this really for me? Or maybe I should try something different. But, nowadays with social networking, with your chat room, with, all the message boards that are out there, the Google groups. I mean, there's so many good traders that are more than happy to share their knowledge with, new folks entering the the market, that the learning curve nowadays is so much easier. It's so much better than it was when I was trading. But I think, just being persistent, it'll come, but you just got to be able to hang in there. And while you're hanging in there, I would say post analysis is critical. Tracking your results, keeping a trading journal is critical. Doing those things. I tell people, come up with rules. I don't even care if they're bad rules, because even if they're bad rules, you'll learn something, because now you know what not to do. Is to just come up with something in writing that you can apply, and just by doing that, you'll learn a lot about the market, what really works and what really doesn't work.
That's good advice. And before we go, we're just going to go ahead and wrap it up. I just was wondering if there were a few stocks on your watch list or something that caught your eye that you might want to share with everybody before we go.
Well, I tell you a stock that, and I might buy it tomorrow, it's a lower liquidity stock, but I really like Comfort Systems. They just reported earnings, over 100% earnings gain. Here's a stock that, it's broken out to new all-time highs out of this, did it here, but it's doing it again here, out of a multi-month consolidation. The volume is just zooming up on a monthly chart. This is just month after month of above average volume on a monthly chart. Got to be institutions getting into the stock, at least, in my view. And then what's happened is it's created a double bottom here. And see, this action is getting really tight as the volume is decreasing. Now, we still got one more day of trading left, so the volume might grow by the end of the week, but you can just see the tightness that's happening after this double bottom. And you can just see exceptional quarterly earnings growth right here. Yes, 130%. The quarter that just reported, it was 130%, 11% earnings growth. Another thing that I like to see is earnings approaching or at all-time new highs. And it's getting that next year, at least estimated to get that next year. You got, the return on equity is a little bit low, but I can accept that when the earnings growth is this strong. I don't mind that. Especially when I also see these institutional ownership increasing like it is. We've got this strong EPS rating, very strong composite rating. You just got so many good characteristics that I like. You got a 1.3 up-down volume ratio. So, it's just got so many good things working for it. So here's a stock that, tomorrow I could very well be in. That's the one I've got on my radar right now.
Where's your pivot for that one, Steve?
The pivot on this one is, let's see. Yeah, 30.89. So I got my little line right across here. So if it breaks above 30.89 tomorrow, and I haven't talked about this yet, but one rule I've got, anytime I see a breakout, the first minute after the open, I don't do anything, because I know that first minute, especially for lower liquidity stocks, the bid-ask spread will be wider than usual. You'll get volatility. And I don't want to get into a stock just from the normal opening volatility, from the open. At least give it, a minute to move around some. And then what I'll do is either looking at a 1 minute chart by that first 1 minute pullback, or if it breaks out to above that 1 minute range, I'll buy then. But I'll do things like that. Now, if the action wasn't this tight and there wasn't an earnings report coming out, then I like to wait about 30, 45 minutes before I get into a stock, because I want to see more evidence. Was volume coming in? Does this bar look like it's going to have range expansion as it's breaking out to above that pivot point? I make an exception as far as waiting 30, 45 minutes. If it's either an earnings gap or if it's the action is so tight, then any move up will get me into that stock. I just wait a minute before I actually execute the order. But then this is a stock tomorrow that I will definitely consider getting into. It can break above $30.89.
And for you, the price just has to break above that, or does it have to close above it?
I'll just break above it.
All right.
Yeah.
Thank you so much for spending time with us and talking about your trading. It's been great to have you as a guest.
I could talk about this stuff all night. You probably could too. I could tell the passion that you got, and I think that's one thing I can say. It seems like all the good traders, they have a real passion for it. It's not drudgery, like, oh, I gotta look at 300 charts. I can't wait to look at 300 charts. I look forward to those weekend routines when I get to thumb through there, because to me it's like a treasure hunt.
Exactly.
There's something out there. There's some winners out there, and it's your job to sift through all the noise, all the bad charts, all the other opinions and stuff like that, and use your rules and be able to find that hidden treasure. And to me, it's just fun to be able to find that hidden treasure.
I agree. I love stocks. I love everything about it. I wish I had more time in the day to look at all the charts that I want to look at. Hey, Thank you so much.
Seriously, Heather, I really appreciate you asking me to do this. It was a lot of fun for me. It was actually fun for me just meeting you, Heather. It's awesome that you put this chat room together. You're not going to be able to get rid of me now. I mean, I'm going to be in that chat room all the time.
Well, it's been great fun. Thanks, Steve.
All right. Well, you have a great night, Heather.
Yeah, I'll see you in the chat room.
Sounds good.
A very special thanks to our guests for being on our show. It's been a lot of fun. Learn more about trading at Tacoma IBD Meetup Group, where it's always free and it's always about becoming better traders. Thanks for joining us on Stock Talk Happy Hour. Good fills, everyone.